There's no doubt that 2020 has been a year filled with uncertainties, especially for investors. However, as the year ends and we head into 2021, there are a few ways you can take advantage of a market recovery, especially as a growth-focused investor. Now would be the time to review your investment strategy with your financial advisor so you don't miss out on market opportunities. Hi, my name is Kobe, an associate with Noor Private Wealth. If you're new to my channel, we focus on helping our clients build wealth in the most tax-efficient way. So let's jump right in. In today's video, I'll be sharing with you 4 strategies you can implement to capitalize on market recovery next year, as long as you can afford the risks involved. The first strategy to adopt if you want to take advantage of the market recovery is to diversify your portfolio geographically to include international markets. As the world anticipates pharmaceutical intervention and the availability of vaccines for the coronavirus, we also expect economies to pick up. China was the first one out of the gates following the lockdown this year, and that led us to increase our exposure to it. This was already paying off in Q2 of this year, when the Chinese economy had a growth rate of 3.4%, while the Canadian economy was down 13% over the same period. Going forward, we're looking to increase the exposure to the South Korean markets. During an economic recovery, cyclical stocks historically outperform defensive stocks, and we couldn't think of a more cyclical country than Korea, with 72% of its index comprising of cyclical stocks. The second way to capitalize on market expected recovery is by having adequate asset allocation to US small capitalization companies. Now, following past recessions, small cap stocks have outperformed large cap stocks after a downturn by 10 to 30%, and we imagine that given the death of the COVID-19 shock, a likely solid recovery is a good setup for small caps. Small cap earnings are expected to rise by 27% over the next 12 months, 9% higher than the expected increase in large cap earnings. Also, small caps are currently at a 12% price to earning discount compared to large caps. Additionally, small caps are trading at a 24% price to earning discount to their historical average. On major vaccine news days, small caps have been seen to outperform large cap by 2%, signaling that there could be further potential outperformance for small caps over large caps on the back of continued vaccine momentum and economies reopening. Therefore, with good earnings momentum and cheaper valuation, we tend to favor small caps for the growth-focused investor. Thirdly, our focus is on US healthcare. We view Biden win and a split Congress as potentially good outcome for healthcare. Any progress on healthcare policies via legislation is less likely beyond a must-pass items such as Medicare and tax extenders. Overall, lower policy risk should be reflected in many areas of healthcare where the policy was an overhang. Also, healthcare is currently trading at approximately 26% price to earning discount versus the S&P 500, which is near a 30-year high. Discounts in healthcare subsectors exposed to regulatory risk may also be considerable. Thus, an upside in healthcare stocks could become notable as uncertainty fades. Additionally, managed care and hospital stocks have rallied 20% on average in the 6 months following elections. The anomaly is likely due to the large discounts that typically gets priced in for regulatory risk, which eventually reverse as uncertainty recedes. And for the defensive portion of your investment portfolio, we would favor healthcare over consumer staples. Consumer staples has outperformed during the pandemic, and we believe it will lag going forward as the recovery unfolds. In the meantime, healthcare, which is trading at 23% discount to consumer staples, will likely to outperform. And finally, in considering investment grade bonds and high yield bonds, these asset classes are opposite sides of the spectrum. When there is uncertainty in the economy, money flows from high yield, riskier to investment grade, safer bonds as investors search for safety havens. In the process, the investment grade bond prices rise slightly and the high yield bonds dip severely. When the economy recovers, the opposite happens, with money flowing now from investment grade to high yield. Investment grade prices drop slightly and high yield bonds rise, almost like the equity markets. So if you are in the growth stage and are looking to make a tactical allocation over the next year, these 4 strategies should help you position yourself for market recovery opportunities. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more videos, don't forget to subscribe. If you have any questions or comments, please let us know below, and the senior investment advisor on the team will get in touch with you. Thank you very much for watching, and I will see you next time.